Good morning and welcome to today's joint webinar between Gravita and Barclays, What's Keeping Charities Up at Night? I'm joined by Barclays, Dassos Alexandrou and Sandy from Gravita. And my name is Katherine Wilkes. I'm an audit partner here at Gravita. I specialise in charities. Gravita is a top 30 accounting and auditing firm with out of offices in Oxford, London, Exeter, Bristol and Essex. We work with hundreds of charities of all shapes and sizes.
Hello, my name is Dassos Alexandrou, and I head up the education team at Barclays, which sits within our public sector team. Our public sector team covers all of the Barclays relationships that we have with local and central government, charities, and the education sector, where we work with over 60% of universities, over 50% of further education colleges, hundreds of schools, and hundreds of international and UK-focused charities. I'm delighted today to be joined by my colleague, Will Hobbs, and Will is going to be giving us some insights into what's going on in the economy at the moment and how it's going to affect charities. By way of background, Will is the head of UK multi-asset wealth for our private and wealth management business, and he has about 20 years experience in the financial services sector. He's a fellow of the Securities Institute and is a frequent contributor in the media to capital market insights on things like Bloomberg's, CNBC, as well as other media outlets. So thank you for joining us, Will.
And I'd like to introduce you to my colleague, Sandy Cochrane, who is a VAT partner here at Gravita. Sandy was in the industry for 10 years before joining a practice and moving into VAT, where she has been advising clients for the past 20 years. Sandy advises a whole host of clients, from multinationals to owner-managed businesses to charities and not-for-profits, and has recently been involved in advising independent schools. We have a number of questions for today's panellists, but we do welcome additional questions, so please pop these in the chat and we will take a look at those at the end. If we don't have time for all of them, I absolutely promise we will respond to you individually afterwards. Okay, so first question to Will. 2025. It has been widely expected to be a year of uncertainty, and it hasn't disappointed. Yeah. Trump, his tariffs, global conflicts have continued, national insurance hikes. What should charities be thinking about in terms of de-risking?
Gosh, it's a difficult opening question, Katherine. Yes, well, we'll try and work it out. So first of all, I'll take a little bit of a step back, and sort of, because the way that is that you've got a set of politicians and leaders around the world, particularly in the US, who are kind of authoring events and changing the future as we, as we read it. I'm not quite sure that we should see them as the author of events. And in a sense, these changes that we're seeing around the world today, they look to be downstream, in a sense, of previous technological changes. So you find that big new technologies come along, distance shrinking technologies. You can think about WhatsApp, or in the past, the transatlantic cable. And these things drive changes in society, changes in the business, changes in allocations of wealth. And that is what sort of drives the politicians at the moment. So in a sense, what we're seeing right now is kind of quite consistent with what you've seen in the past with regards to kind of big industrial revolutions. These things are very turbulent periods for society to absorb, and you can find that politicians react. So in a sense, for many charities, and obviously we invest on behalf of a lot, it's really about trying to keep that medium-term focus. And remember that what you're seeing day to day in the newspaper isn't necessarily always entirely relevant to your investment decision-making, that actually the returns on your investments are going to be decided by what the world looks like in 5-10 years' time, not necessarily how it looks from our current quite chaotic vantage point. If you are in an industrial revolution, and in many ways I think we probably are, then that is what drives your long-term returns. How humankind is unevenly given more superpowers, which makes us more productive, improves living standards over time unevenly, and that's what drives your asset return. So it's about keeping risk to a degree that you're comfortable with and trying to stick with it, I think.
So in terms of charity with a large investment portfolio, and you're talking about medium-term returns, what should they be considering at the moment in this current climate?
Well, the big question for sort of long-term investors at the moment is really about the role of the US economy. Is it, there's a lot of big opinion pieces at the moment. Is the American century over? Do you need to look beyond US assets and those kind of things? Because if you think about the last 15 years in particular, the most profitable investment decision has been going long, buying US assets and leaving it unhedged, so letting the dollar do extra work for you. That no longer looks to be such an easy case to make. And so a lot of investors are thinking about more international diversification, where there might be sort of strong opportunities to make decent inflation beating long-term returns. And that's really the key. Is I think at the moment it's about staying as dispassionate as possible. It can be hard, can't it? Every day we're sort of, besieged with bad news and so on. And if we've got 7% of the people who've ever lived alive on the planet today, there's always going to be enough to fill a 24-hour news feed. But I'm not sure that's an accurate reflection of the world as it stands. And it's not that I don't see risks out there and we don't worry about stuff, but just I think there's still sufficient case for a kind of believable, plausible optimism about the medium term that there ever was. And that is kind of separate from how the news agenda works, I guess.
And is there anything in particular charities should be considering putting on their risk registers, particularly relevant at the moment?
Yeah, it's a great question. I mean, in a way, again, I think I often feel that the media as they stand, there's a negative bias to the incoming news. And so we're sort of over-covered on the risk front. And in a sense, I go back to that point that remember that risk is two-way in a sense. Things can go right as well as wrong. And we're always tending to focus too much on the downside. And often what we find at the moment is that investors feel the upside looks very woolly, the idea that humankind can continue to solve problems and problem solve, as it has done in the past, the further back you stand. But those kind of recessions, depressions, pandemics, they feel much more tangible in our consciousness, don't they? And so I think they can become over-exaggerated. And the final positive point I'd make, just remember that it's not something that gets reported. And this is an updated statistic from a guy called, I think it's Hans Rosling. But yesterday, 106,000 people were pulled out of absolute poverty, and every day for the last 35 years. Now, in a sense, it's an amazing story. It's not that there's no suffering to continue to worry about, but we also need to remember some rational optimism, because that helps us, I think. Believing that there is a solution is a key part of finding the solution as such. So, yes, an optimistic start. Now let's do it all down and get miserable. Yeah.
I like your point about an opportunity register. What do you need to do in order for everything to go right? It's a really interesting opportunity for charities and not-for-profits to turn things on their head and really think it through in a different sort of lens.
Well, I do think also, I mean, a lot of the customers we speak to at Barclays, whether they're individual investors or companies evaluating a kind of medium-term investment decision, building a data center or whatever else, there's a sort of obsession with sort of understanding the moment we're in as an influence on those medium-term decisions. And so what you've got to then say is, well, what at the moment is actually informative about a 5-10-year view hence? And in reality, it may not be that much. The world economy mostly muddles through, and that's because of us. We're way too restlessly innovative to bet against for long periods of time.
Yeah.
And that's really the sort of key thing to think about.
I think what we have to bear in mind is that whilst there are things that move quickly, be it by political news or technology or anything else, and people feel like they're constantly trying to keep up, the reality of it is that a lot of the organisations that we work with, charities, education institutions, they're not fast moving, they're slow moving, and they're very long termist in terms of what they're trying to achieve around their charitable objects. Trying to cut through the noise of the immediacy of what's happening today to think about how that affects things on the long term, and which things don't affect things in the long term and could just be set to one side, is a really tricky thing to navigate. And so just with that thought in mind, I guess it would just be really good to dive into a bit more around where we've got grant-giving organisations or organisations that have got endowed funds that they're trying to manage and protect the value of in the long term. What sort of advice would you be giving to the finance committees around how they pivot their portfolios and manage their risk in order to protect that long-term value and be able to deliver against their charitable objectives?
All in on gold and Bitcoin. I think that's generally what we keep saying. Yeah, no, it's interesting. The sort of mealy-mouthed answer is about diversification, because if what you're trying to access, if you think about the Steven Pinker point, which is, that genius is evenly distributed across the world, and therefore it doesn't cluster in the already rich or particular castes, so on. And so in the bottom billion people in terms of income distribution, there are 1 million people of genius level IQ. Now, the point about how that links to your investment plan is that you are trying to access the genius, the potential kind of innovative powers of all of those fellow human beings. And so in reality, there's no requirement for the recently successful economies to sort of remain as such for the next 10, 20 years, which remember is mostly your investment horizon. And so you're really just making sure that in a way, risk reduction is about spreading your investment exposure as widely across the planet as possible. And you're assuming all the time that the past doesn't have to be prologue. If you think about it, particularly at a moment of potential rupture that we're in right now, there's no reason for the winners of the last 15 years to be the winners of the next 15. And so you're just trying to make sure that you're trying to invest beyond those kind of idiosyncratic country sector risks and diversify across the whole piece. Now, to be honest, when you're looking at capital markets, it's quite interesting, and you put them all into a kind of statistical blender and try and find different shapes of return, i.e. kind of diversifying exposures. It's not actually that many different ones, funny enough. You can get equity risk, you can get credit risk, a bit of duration risk, there's something associated with commodities. And really how you organize those is really about your risk appetite, how long your investment time frame is, what your capacity for losses in the short term, all those kind of things. And that's really the big story, I think. It's just about making sure that you're turning up in sensibly diversified fashion. And we spend a lot of time on this. We have a group of PhD mathematicians locked in the basement, constantly trying to mathematically imagine hundreds of thousands of different futures and really finding the mix of assets that sit most robustly. Really, that would be an illegal thing. But yes, they're like, yeah, that's it.
All right. Yesterday, we had news about rising inflation again.
Yes.
On the backdrop of, quarter one, it increased in prior quarters and a very high inflation for the past few years. Cost inflation is a real pinch on not-for-profits. They can't always pass this on to anybody, really. They have to take the hit. How would you advise a not-for-profit to try and beat this cost inflation? What could they?
It's a really good and difficult question. I mean, the first thing I would point out, which is, again, it's a little bit of a wonky point, but remember that the statistics that come in kind of almost daily on the global and UK economy, they're mostly worth just tuning out on. Right? The data set with which we try and measure the economy, it does so imperfectly, and it's actually probably more use over longer periods, because what you find, for instance, is that GDP trends, not the month-to-month, quarter-to-quarter, the GDP trends are correlated quite strongly with almost every other measure of human flourishing. So over time, it tells us something, but on a sort of snapshot basis, I don't think it tells us much. And inflation is an incredibly hard phenomenon to capture.
Yeah.
Now, thinking further on now, you can think about the latest, the budgetary measures and some of the other sort of pressures going on that affect large parts of the services sector, in particular in the UK, bits where there's possibly not that much ability to take cost out by introducing technology or take stuff out. So you've got this kind of rising cost at the bottom, and then you've got, all of the other squeezes coming down. And so that's been very difficult for large chunks of the corporate sector. Now, at the economy-wide level, there's a slightly different story, which is a little bit counterintuitive, possibly, but it does explain past periods of accelerated growth across many economies. And my argument would be that there's the potential for this to happen again, which is that if you think about it, when you've got an attractive new group of technologies coming along, and you can think about machine learning, maybe generative AI in the future, if you've got very cheap workers, there tends to be very little incentive for entrepreneurs and leaders to introduce new technology so that labor can be reallocated. It's a messy and cruel process. It sounds clean on the spreadsheets, but actually, ultimately, it does lead to better places. So sometimes what you can find in the past is that more expensive and scarce labor can be a huge incentive for companies to invest. And that is something the UK needs to do so badly. The last 15 years, it's really underperformed on private investment. So we need to give companies the confidence to do that. But the effects of that are going to be uneven across the economy. Some parts will suffer more than others in the short term. But ultimately, the bet is that you can catapult yourself to a better level of growth. That's the hope, anyway.
Charities, not-for-profits benefit by increasing investment.
Well, yes, ultimately, your faster trend in growth filters through to all different bits. And remember that the UK, the starting point for the UK is, and this is not a distributional story, we can talk about that later, but in aggregate, the UK consumer is in good health. The balance sheet is in good health. Positive real wages are a hugely important force that allow people to feel richer and be more likely to spend.
And give to charities.
And give to charities, precisely. So, but I do think that one of the problems the UK has suffered from in the last 15 years in particular is a kind of a branch of sort of ADHD in a way, policy ADHD. You know, what you want is as much confidence in the future as you can possibly muster.
Yeah.
Acting against that are every year you have a new industrial policy to get to grips with. Every year you're looking at, you know, is there going to be totally different trading arrangements with all of my trading partners in Europe, US, wherever else, you know, all of those kind of things. The UK government in the past has been famously quite good at providing a bit of grey and boring for the institutions to feel a bit more comfortable. That's kind of what's got to happen now, I think, to allow those companies to invest and to allow the UK to fulfill some of its potential.
Interesting.
I think from my perspective, I think if we move away from the inflationary news and think about the real-term impact on the audience that we've got here today, I think one of the challenges, particularly around mindset, is the fact that a lot of our clients will have relatively inelastic income lines in terms of if you're an education institution, fees are not that flexible. If you're a charity that's perhaps reliant on local government contracts, again, the ability to pass on cost increases might be difficult over the life of a contract. Then if they then jump to the cost line and think about, well, how can you reduce costs? Now, the challenge with doing that is cutting people and cutting costs in isolation can only ever be a path to shrink to greatness, because without having something else to bring in income to then sort of think about the diversification of services and things like that, which will just mean that you end up doing less with less resources. So I think one of the big challenges that I always sort of pass on to our clients is, what are they doing to grasp what their mission, their vision and their purpose is? Thinking about what are they bringing that the next charity down the road isn't bringing, or that the other education institution in the next town along isn't bringing, and what's going to be their role, and making sure that they start to leverage that and weaponize that into being some sort of USP, so that actually when it does come to the crunch point of somebody deciding which school they're going to send their child to or which charity they're going to do some fundraising for, they've got a clear message that they're getting people to buy into, because it is increasingly becoming competitive in all of those sorts of markets, and that mission, vision, purpose thing really is something that I think will differentiate the winners from the losers in these markets in particular.
And I suppose an additional challenge to that is charities where there is very lumpy income and you don't know when it's going to come, where it's going to come from. How would you advise a charity to manage that, and is there anything the bank can support with?
Yeah, well, I mean, obviously we'll always have to speak to any clients that we would have around helping them manage their working capital flows. As you say, though, the unpredictability of these things makes it very difficult to budget and to build a financial plan around. So I guess the way that we sort of see this successfully being addressed is basically by having the right infrastructure and good planning around, if it is fundraising that drives the income line of a charity, making sure that you've got a clear plan around how you're going to differentiate yourself, what resources you're going to put into doing those things, because all in having a plan is you need the expertise and you need the skill set within an organisation to be able to deliver against these things. And inevitably, what you've done in the past might not be successful in the future. So if you're very narrow in terms of how you generate income, but if that's just, for example, public fundraising, we know that the wealth of the population goes up and down through economic cycles. It might not be a sustainable thing to be doing, and therefore actually, we see charities diversifying over time into shops, into long-term contracts, into different areas of charitable activity, just to try and dilute and smooth over the lumpiness of those inward receipts that they might be receiving. And that's sort of the best that charities can do, really, to just manage through that risk and the cyclicality of things.
Super.
So Sandy, thank you for waiting there very patiently. I've got a few questions for you as well. It feels like there's almost a weekly announcement at the moment on independent school mergers, and we're seeing a lot of activity on that in our business, and indeed some closures, with the majority of the news rhetoric around it blaming the introduction of VAT onto school fees. What are you advising clients on this matter, and what practical steps can school groups take to address these, and where do you see the sector going from here?
Okay, well, thank you, Dassos. And yes, whilst VAT has been the headliner for the school closures, there have been other contributing factors, such as the rise to national insurance on staff costs and the introduction of business rates. But we've actually been involved with a lot of schools recently, and we've done the first tranche of VAT returns, and we've actually got some money back to these schools that they never thought they were going to get. Changing that sort of mindset a little bit. VAT is not necessarily the bad guy, but where we're seeing a lot of recovery on independent schools is where they do a lot of building works. Now, these building works could have taken place several years ago, and the build or the asset that they've created is being used now as from 1st of January in making taxable supplies. So I'm seeing it as a bit of a positive, and it's a bit of changing the mindset. Before I answer your two specific questions, though, I thought I'd like to take a step back and just explain to the audience a bit about VAT and how it generates revenue for HMRC, and a bit of how the mindset of charities and independent schools can be changed from what it is at the moment. So if we look at the revenue that's generated by HMRC on the various taxes, and I've got the stats for last tax year, 24-25, income taxes, we expect it's going to be the highest generator. Obviously, we're all paying national insurance on the salaries that we receive. And income tax, would you believe, is £277 billion. So that's the highest generator. Coming in second is national insurance, 180 billion, and VAT coming in a very close third. I was quite gobsmacked to see that HMRC are bringing in £200 billion, would you believe, from VAT. Third, my maths, is corporation tax, and corporation tax is coming in at under 100 billion. VAT is twice as much. You see there's a lot of emphasis on corporation tax. VAT seems to be it's only 20%, we'll leave that till later and deal with it at that time. But we put that into context. How is HMRC generating all of this revenue from VAT? My own personal view, it's through penalties and surcharges. We have taxpayers there or non-taxpayers sitting there in their offices, merrily doing their business, get a letter from HMRC, you owe us X amount. Taxpayers going to get really concerned. We've got a document from HMRC, a government official. Quickly, where's the money? Let's pay them and get rid of them. Well, actually, if you go to a VAT advisor, you can look at ways of mitigating those penalties. HMRC aren't necessarily right all the time. So you get somebody in. Yes, there's that upfront cost, but it could actually have that long-term benefit. So don't be scared when it comes to VAT. Let's get that revenue down, and let's use your advisors and get that revenue down, because we need that money to be brought back into the public. Use it for the charities, use it for the schools where we can. So I just wanted to take a little bit of a step back there. And I think, a war story, if I can add one. We were working with a charity a couple of years ago, and not a school, they didn't need to be VAT registered, and they procured services from non-UK suppliers. Now, for people that don't know, if you buy services from outside of the UK, in particular services, that supplier won't charge VAT. However, HMRC kindly, many years ago, introduced what's a mechanism known as reverse charge accounting. And what that broadly means is that for somebody buying in services from abroad, they treat that as if they both made and received the supply. And if I can give a very quick example, what that means is if a charity has brought in £100,000 worth of services from, let's say, a US supplier, £100,000 is above the current VAT registration threshold of 90 grand. They buy that service in, they compute the input, the VAT on that cost, so £20,000. But they've also got an obligation to account for deemed VAT as an output, as a sale. So that £100,000 plus £20,000 VAT. that business isn't making any taxable supplies, it's not VAT registered, but actually now it's going to have to VAT register, account for the VAT of 20 grand on that sale, but because of the nature of its business, it's not able to recover that VAT. Lo and behold, in my case, it was £1 million. Ouch. The charity got a failure to notify penalty. We came in, we got that mitigated. They were left with a bill for about £1 million because this was going on for several years. So, you know, like I'm saying, please take care. And again, before I answer your point, I think it's really useful for charities and particularly the independent schools that haven't been previously registered to change their mindset. You know, the headline is the saying VAT is a cost. It's not really a cost. The schools, charities, once they're VAT registered, they're gatekeepers. They are collecting the VAT to give to HMRC. It's not their income. That income should not go on the P&L. Comes from the parents, you know, paying for their children, let's say if it's going to school. Move that to the balance sheet straight away. That's a liability. You are collecting that money for HMRC. It's not yours. But what is the positive? You collect that money, you give it to HMRC, but now you've got an ability to recover VAT on certain costs. So let's maximise that. You know, you look at the independent schools, and I'm not picking on them, but, you know, it's quite an important topic. So if you look at the fees that were being charged 5 years ago to what they're being charged now, it's already gone up by 25%. Schools can absorb the VAT, they can take a little bit of it, but it all depends on where we're going. Practical steps, you've asked about what can schools do, what are the practical steps that they can take. Obviously, they want to take professional advice because it is a very nuanced area. There is the facility to go back 4 years for certain expenditure or 6 months for certain expenditure. HMRC are still faffing because they still don't know what they're doing. It's just independent schools or charities that are becoming registered. Keep your records together. Make sure you keep your receipts. Make sure you've got all your evidence. Make sure you know exactly what cost you are incurring and what income that is relating to. So having good records is really, really important. You know, we look at schools and the VAT, and to me, it's a perfect exam question. You've got a lot of non-business income. You know, the grants, the STEM pupils potentially, and you've got business income. Once you've got the business income, is that business taxable, subject to VAT, or is it exempt? If it's both, you've got what's known as a partial exemption calculation to do. And, you know, that in itself is complicated. So unfortunately, I do feel very sorry for the independent school. They've been thrown in at the deep end with what I can say is a very complicated set of rules to account for VAT. But get good advice, keep your records as accurate as possible, get your invoices for your costs, are the main things that I can perhaps encourage. And I think to answer your second point, where do I see the sector going? Well, that's a really difficult one. We're talking about charity sector, or are we talking independent schools? If we're going for the latter, we're seeing a lot of schools closing, but we are seeing a lot of schools merging. We're seeing a lot of schools diversifying. So, you know, I was speaking to a school the other day, and a lot of the independent schools have got very salubrious grounds. Why don't you use those grounds? Let them out for people to come and do filming. You can tax that income. You can therefore change your recovery rates on your partial exemption. But, you know, use that. You've got further education colleges, they've got dining halls. Use them to, you know, for local wedding venues or whatever you need to do. But there are ways of diversifying. There are ways of maximising your taxable income. My key point is you do need to get professional advice, and I will keep going on about it. It is an upfront cost, but hopefully there is a long-term benefit.
Thank you. And I think there's two really important things that you sort of allude to in there. The first one was around the speed at which the legislation came in, caught a lot of institutions, you know, on the wrong foot in terms of, I think there was always an expectation that when Labour came into government, they would introduce that on school fees, but not by the following January. There was we thought there would perhaps be something that will come in late 2025 or probably 2026. So that's something that you call a lot of people out, and therefore the advice piece just to get mobilised and get everything thought through properly and planned for is really important.
Absolutely. I mean, you know, they introduced the VAT on the 1st of January. I mean, why did they not introduce it at the beginning of an academic year? You know, it caused a couple of problems there. So absolutely.
Yeah, and then the other thing, I guess if I'm putting myself in the position of a parent, is that, you know, whilst there might have been fee increases over previous years, that money was going into the coffers of the school so they could reinvest in resources, teachers, the estate, etc. Now, as a parent, I might be paying up to 20% more on my fees, and I've got nothing extra to show for it. So that makes the decision of whether I send my children to a school or not more difficult, and it puts the schools in a more difficult position of being able to differentiate themselves against the next best option, because there's that additional cost in there that they're going to struggle to show additional value for. And that's where the proper planning around better use of the estate, mergers to drive better efficiencies on the cost line are really something that, you know, there's been a lot of activity on in the last few months.
Exactly, and that's what we've been advising on, because a lot of schools haven't done fees plus 20%. They have actually looked at all the costs, looked at whether they can absorb to just do a slight increase on the fee income. And that exercise is looking at the costs and the recovery they can get. So you stand back, you look at your income, you look at your costs and come to a really good sort of level to say, well, yeah, we're not charging those parents 20% and here's why. And I think that is an educational piece.
It's very interesting what you say. It's all quite circular in terms of diversification and this USP point coming back in terms of things like additional buildings, additional facilities, but then the opportunity to actually reclaim the VAT. It's very interesting. In terms of VAT and the VAT threshold, £90,000, a lot of charities kind of think they're exempt from VAT, but it doesn't sound like they are.
Well, I mean, the reverse charge example I gave is a perfect one where they wouldn't be. You know, there are a lot of reliefs out there as well that people can take advantage of. So, charities, independent schools, to keep these costs down. The exemption, it's a difficult one because charities, as you quite rightly say, we're not for profit. We're doing stuff that's in accordance with the Charity Commission. We must be exempt. It's not necessarily the case. And, you know, I think somebody mentioned fundraising earlier. We had an incident, you know, a matter to deal with where fundraising actually wasn't exempt in that particular case because they'd done something that didn't fit the criteria that would fall within the exemption. We talk about funding and, you know, funding, we look at contracts because, yes, funding, the perception is it's given freely and, you know, which is great. But there'll be one little thing. So, you know, from that perspective, if a charity is receiving grant funding and all you're giving is a mere accountability of the spend, that's great. But actually, if you're doing a little bit more to receive that fund income, that's not exempt anymore. You could actually be making taxable supply. So you do really need to take care and not just take terminology as a given that funding's exempt, therefore we're an exempt charity.
Yeah, absolutely. I suppose this is particularly relevant to a small growing charity, someone who's a charity that is considering doing trading activities. In terms of VAT and, you know, the applying to charities, are you expecting any changes in the future?
Oh, well, I'm going to say yes, absolutely. You know, VAT is ever evolving. There's VAT cases that come out daily. There was one to do with hospitals being a, you know, care provider, and whether the car parking should be VATable. So yes, I do expect a lot of changes. There was also a HMRC brief that was issued early this year. I think it's HMRC Business Brief number 2. And it was talking about health providers forming VAT groups and HMRC looking at the potential avoidance that that's bringing with it. So there will be changes coming along. And, you know, what we saw last year and what we're seeing this year, different. So yes, there will be.
And if you had one piece of advice for the charity sector in relation to VAT, what would it be?
As soon as possible, because unfortunately, you know, there's not one umbrella that's a catch-all. There are these nuances. You know, we talk about charities, we talk about schools that are charities, we talk about care providers, but we've got the theatres, we've got the cultural exemption. You know, I've got a charity in London that I was advising a couple of years ago, and the cultural exemption kicked in, and so it's quite diverse.
Thank you, Sandy. I don't think we could have a panel session with accountants, bankers and economists on it without talking about the wild world of international trade at the moment, particularly with Donald Trump's tariff implementations and then subsequent renegotiations. And then obviously this week we've had a common agreement between the UK and the EU. Just from the perspective of our charitable clients and education clients, what sort of opportunities and challenges do you think all of this international trade deal news flow will be presenting?
Very difficult question. I mean, so we don't know where we're going to end up, as you rightly point out. We've gone from US effective tariff rates back a sort of 150 years in many ways. On some measures, you know, you go further back than that. Since the climb down with China and some of the other kind of deals that have been, you're just back to 100 years ago in terms of effective tariff rates. So it's still a pretty big increase from the US. And if you just treat it as a tax rate, because mostly what will happen if past is prologue on this case, and it's not a guarantee, but the sort of core assumption is that the US consumer will end up paying for these tariff increases. The poorest parts of society are going to pay more for this because goods are a bigger proportion of lower income household spending versus services. Simplistically, US consumers will end up paying more for their imported goods, so more for their iPhones, less for their childcare. It's a sort of very rough and very kind of reductive take. That will have an impact on global growth. The US consumer, the US economy is incredibly important still for the global economy. But I would stop short of sort of disaster in a sense. And remember that there are some offsets, which is that, you know, if you think about what this Trump administration has managed with Europe, that will go down as potentially a feather in their cap. You know, many US administrations before this have been trying to wake up, you know, the potential for sort of taking more responsibility for Europe's own security. You know, this more abrasive tone from the US administration has managed that, and that may end up being more consequential for the UK and in a sense some little bite out of the US trend growth, just because a revitalized Europe, if that indeed, you know, if they can grasp the nettle as such, that will be more important given how important proximity is in economic terms than a US slightly slower growth. So it's very interesting, I have to admit. And there's a sort of, you know, there's still some uncertainty about what this administration is trying to achieve with all of this. There's a number of objectives, some of which are contradictory, but that may just be a function of this kind of art of the deal, the negotiating strategy.
I do think, though, I think that's causing a lot of nervousness within our client base, particularly around what this means for the upcoming spending review and where funding is going to go. I think it's quite clear that it's going to be an increase in spending in defence. If that has a knock-on effect towards spend on international aid or education spending, then, you know, that causes some consternation for some of our clients that we have to sort of really sort of think carefully around how prioritised they are in the UK government's mindset.
And there's some really challenging trade-offs to think about in these situations, as you rightly point out. And it's not, I often think that the media debate is, I understand, quite reductive on these things. And again, I would go back to the initial point that mainly giving us the kind of negative scenarios ahead. There are scenarios where the UK grows a little bit quicker than feared, and there is less recourse to have to go back again to tax rises and other sources of funding. It's quite hard to handicap at the moment, just given where you are in the short term. But I would argue still that, I mean, remember, if the UK from this point, just imagine that we had a no deficit. If you manage to return to your post-war real trend growth rate of about 2.5%, then your debt to GDP goes almost to zero within 50 years. So just remember that these long-term assumptions with regards to debt to GDP, financing, all these kind of things, they are minutely sensitive to your trend growth assumptions. Now, rightly, many of the institutions we pay for, or we look to for kind of measuring these things and so on, they're going to take the slightly negative case, a cautious case. But remember, there are also scenarios where this goes a bit better if you on a 1-2 year view.
Yes.
Always looking on the bright side. Yeah.
It's interesting you talk about Trump's tariffs in the US and less money that consumers will have in the US. A lot of our charities are dependent upon donations from the US, so that will have a direct impact. So just sticking with trade, And thinking close to home, let's think about the EU. So the OBR last October stated that imports and exports are lower, about 15% lower than had we stayed in the EU. There are now new trade deals with non-EU countries, but the actual impact is not material. Are we still feeling the impact of Brexit 10 years on? And what can a not-for-profit do to mitigate this?
Just on your US point, just as a reminder again, just a slightly more positive context as well. Just remember that between the first quarter of 2019 and the third quarter of last year, the US consumer, their net asset worth was up by $50 trillion. So this is still a phenomenally wealthy, well-armed consumer, even if in the short run you are looking at slightly more difficult outlook and so on and so on. But on the UK and Brexit, again, I often think this is a good example, just thinking back to the kind of the run up to the vote. And on one side, you were promised that you were going to enter the sunlit uplands of an economic boom if you left the EU. On the other, it was sort of, they were saying if you leave the EU, we're going to be in a depression and all sorts of other things. Now, neither was ever going to be true. And subsequently, what we've seen is that guesses at how much the UK has been impacted by this have come down and down, and they're almost into kind of measurement error territory. So again, steer clear of the kind of really extreme cost of Brexit ideas. They're mostly a function of ideology rather than anything facts on the ground. It has been a headwind. My assumption is there's been a little bit less investment because of this, and like you say, the trading picture has been more difficult as a result. The interesting thing about that, though, is you saw a big drop in trade with Europe because of those extra frictions, but because of the nature of global trade and how it's organized, that was matched by a drop of trade with the rest of the world as well. So it just shows that trade is so interconnected as it currently stands. These things are more complicated always. My personal feeling, just from a sort of economic logic perspective, is that given something called gravity theory, which is still weirdly, you trade most with by some distance, your nearest geographic neighbors. That seems to be the still very important point, even with all the container revolution, TNT and all this, and it still seems to be the truth of it. So minimizing friction with Europe is going to be important to whatever extent you can. And the Windsor framework that was negotiated under Rishi Sunak with regards to Northern Ireland, it's potentially a template of where you can move slowly but surely towards, if you can, minimizing those frictions and making it easy as possible to trade with our nearest neighbor. And that may even be given a bit of extra impetus, if you think about it on a 5-year view, by the fact that the US is now less happy with the rewards to, running the global trading system and doing the sort of dollar hegemon and all those kinds of things. And so there's a chance probably, if the US is turning more nativist, then I think we probably want to make sure that we cozy up to Europe to whatever extent is possible within that Brexit framework.
And not-for-profits, charities specifically, is there anything they should be thinking about?
Well, again, in a way, you can get tangled up with this stuff, and you've really just got to play the land as it lies as such. I think cozier relations with Europe would be slightly better trend growth rate, but it's not going to be definitive in whether the UK wins or loses as such on a 10-year view. That's going to be more about how we reinvigorate the sort of innovative and experimental juices back in the UK and make the most of things like our incredible primacy in universities and education generally, and having some of the world's greatest cities, all those kind of things, I think will probably be more definitive in a way. We have much that we can do ourselves without worrying as much about trade negotiations, although that would be an important kind of step in the road, I think.
And before we go to questions, a quick question for Dassos. So if a charity is thinking about borrowing, what should they specifically be considering in the current climate?
Thank you, Catherine. Distill it down into 2 core things to think about here. Firstly, with my pure banker hat on, is can you demonstrate the ability to generate enough cash to pay back the money that I lent you? That's the ultimate bottom line question that you're trying to get to an answer of before you decide whether you want to borrow some money. But in order to get to the answer for that question, I'd like to take a step back and then come back to this idea again of mission, vision and purpose and knowing your place in your sector. I find that a really, really important thing that a lot of organisations don't clearly articulate and haven't fully sort of built out a strategy around. Because what I find is that the successful organisations that have very clear mission, vision and purpose are then able to distill that down into a strategy for delivering that mission, vision and purpose. And then, once you've got the strategy, you can then start to operationalise that and think about what do we actually need to do as an organisation to deliver against our charitable goals, what people do we need, what resources do we need, how are we going to go about addressing the challenge of the business area that we're looking to expand into. And organisations that can very clearly articulate that tend to have better USP, they tend to be able to have better brand power with their potential customers, and ultimately have the ability to attract talent and then eventually the strength of customers that they want to acquire. So having that core foundation stone there drives everything else that follows off the back of that, which then ultimately leads into business performance type things that come back to cash flow and cash generation. So they're the sort of the two pillars of, if I can be satisfied that a charity is delivering on those things, then we're halfway there in terms of having a credible story through which we can actually provide some lending to an organisation. Then you get into the mechanics of actually how sticky are cash flows. If you're an organisation that's reliant on the lumpiness of donations, for example, that might be a more difficult proposition to lend into. But anything that, if you've got the ability to demonstrate a really strong track record, that gives you some credibility. Anything linked to like long-term contracts or long-term partnerships that generate cash flow. Take the example of the education sector, where you effectively got students that are contracted over their life. I know they can leave through the course of a year, but generally you can demonstrate a trend of the stickiness of a student. Again, you get some reliability of being able to look back at the empirical data to evidence that somebody will be able to afford to pay you in the future. And another important thing that then comes off the back of that is plan Bs. So, what can you do if your plan A doesn't work? What were the other levers that you've got? Organisations that might have lots of assets that maybe they can look at disposals of as a potential fallback for any issues in the future, or providing security and that sort of thing, can also provide comfort to a lender when we're looking to lend money into a charitable organisation. So lots of these sorts of things factor into our thinking. Hopefully that gives you some good tidbits to think about.
Fantastic.
Thank you. Right, we've got one question here, and it's to do with the introduction of the new charity SORP. So the question is, the new SORP is keeping me awake at night. How will it affect my charity? And I think that's for you, Katherine.
Oh, well, that's a big question. Again, one that we could go on for days about. And it completely depends. It completely depends on your charity. At the moment, we're in the consultation phase. Got until the 20th of June to comment on the new SORP. Then we'll go into a revision phase in the summer, and then the final SORP will be available, signed off over the summer, and be available in the autumn for implementation from the 1st of January 2026, and that's for accounting periods beginning on or after. So the good news, if you've got like a March or a June year end, that's actually not going to impact you until March 27, June 2027. So a couple of things that are coming up, the reason for the change in the SORP, and we have been talking about it for some time, that it is on the horizon, is that FRS 102, which is the main UK accounting standard, is harmonising with IFRS 15 and IFRS 16 specifically. Basically, the SORP has to jump into line with this. And that it's also given them an opportunity to talk about proportionality. Some of the existing SORP is a bit disproportionate. If you are a charity which has a £501,000 of income, you have to do the same disclosures as that of the RSPCA, for example. At the moment, we have the two-tier system, so charities below or above £500,000 of income. In future, there will be like a middle tier, and that will be for income between 500,000 and 15 million. And the impact of that is some of the disclosure will drop out for those charities. There won't be a need to produce a cash flow statement only those of the 15 million above income charities. There is some new disclosure required in the trustees report, some enhancements, and also some of it drops out for some of the smaller charities as well. And then the real event is around the accounting changes, so leasing and revenue. And these are some quite big changes that could fundamentally impact your charity. Revenue is going to a 5-step model where you identify the contract, the performance obligations, transaction price, then allocate your transaction price across your performance obligations, and then recognise your revenue. This won't impact grants and donations, but if you are performing a service, say you are a stately home, for example, and you sell a ticket for a couple of visits and an afternoon tea, that's when you need to start thinking about whether or not, or when those performance obligations are. I would say this is probably more relevant to a commercial situation. If you sell a machine and you actually deliver the machine, you deliver some installation, some training, some maintenance over a period of time, a longer period of time, for example, you've got lots of different performance obligations. And in actual fact, one of the challenges is actually allocating that revenue over those performance obligations. So something for your charities to take a look at, but probably not completely relevant. However, leasing will be very relevant to many charities, particularly if you say rent your building. It'll be quite a substantial number in your accounts already in terms of rent, to put a right of use asset on your balance sheet and a corresponding liability. The calculation is complicated, and you need to calculate it using the present value of future lease payments. And instead of putting rent in your statement of financial activities, you will put depreciation and interest, the unwinding of the discount, essentially unwinding of the lease liability. Loads of things that you can get ahead now and think about. Start talking to your accountant. We're very happy to help. We've got a great accounting and outsourcing team who will very happily put you some spreadsheets together. Start taking a look at the relevant information, compiling those lease contracts, particularly if you're a large charity with lots of different offices, lots of different centres all over the place. You might not be completely aware of the leases that they have. But there is some proportionality, some light at the end of the tunnel. If your lease is less than 1 year, or you've only got less than 1 year left, you don't need to worry about this. Or if it's of a low value, and low value is not particularly defined within the standard. However, you can imagine if it's like a franking machine, you wouldn't put that on, but if it's a building, you would. So start taking a look at your contracts. Things that are going to be particularly challenging in terms of the leasing contracts are the discount rate that you will use. If there is one in your lease, it's very, very straightforward. There might not be. So then you need to look at your incremental borrowing rate. This is another issue. Some charities find it hard to borrow, so hard to obtain that discount rate. So then you'd look at your savings rate. That's another way of doing it. Another question that has come up is in terms of covenants. If you are borrowing, this is going to completely change your covenants. Start talking to your financial institution, your bank at that point. Transitional provisions, how you actually start to adopt this standard is, again, can be very tricky. And there are options, less so with leases, but there is for revenue. And then another thing just to bear in mind is the auditing threshold. So if you've suddenly got lots of assets on your balance sheet, you might actually breach the asset threshold for an audit. So watch out for that one if you're not currently being audited. Then there's continuous monitoring. This is unfortunately not a one-stop shop of like just do it once and it's all done. You just need to continue to go through this process, any new leases that come up. But I would recommend just looking at this really early. Your accountant or Gravita could be very happy to help you with some early reviews, early compilation of this data. And we have a fantastic 10-point checklist.
Thank you, Katherine. Well, we're coming up to 11 o'clock, and so that's all we have time for today. But I'd just like to take the opportunity to thank Katherine and Sandy for inviting us to be on your panel today. And thank you to Will for joining me.
My pleasure.
And today we have focused on VAT, general economic climate at the moment, and just touched on some accounting changes. You will see a QR code come up at the end of this webinar, and we'd strongly encourage you to sign up. You'll receive updates, you'll get invited to webinars, and if you have any final questions that we haven't touched on today, please pop those in the box. Thank you very much for joining us today.
Thank you.